Hello. I'm just trying to get set up in the right space. I'm at my mum's house this week taking care of her dog while she's on holiday. So just trying to find the right place to set up, where lighting is good and all the other things. And I just had a bit of an issue setting up the stream. Here we go. So, guys, let me grab my can of Coke. Coca-Cola is at a 52-week low, despite the price of Coca-Cola never being higher. And so I want to talk about... oh, this is Teddy. Hi, Ted. Do you want to say hi to the YouTubers? Do you want to come up here? There you go. Here you are. There's Teddy. So, do you want to give me the ball? No. Likes to catch the ball, but doesn't like to give it to me. Right, so yeah, I saw that Coca-Cola was at a 52-week low. Being completely honest, I was doing research as to what would get more SEO on YouTube to get me more attention, more click-through rate. I always want to be transparent about that. So that was kind of the avenue I came into this, and actually it coincidentally collided with a video that I plan to upload on Monday next week, which is where I look at the top stocks at 52-week lows by super investors. So I'm going to be looking at 5 stocks, and it's going to be really quick analysis on each one. But of course I do a deep dive, and I just condensed the deep dive into quick analysis. But I thought, why not do the deep dive on a live stream, give you guys a bit of an idea of what I look for in a stock, in a position. So please ask me any questions along the way, or tell me when you think that I'm wrong. Yeah, so let me just check that the stream is up and running. Appears to be live. Cool. So, right. We're going to look at Coca-Cola, and then we're going to look at Pepsi and a couple other companies that are these are stocks that are all owned by super investors, the world's best investors, and so they're holding them for a reason. They've got that. I think it's like one of the things is, if you just look at positions that are held by super investors, you won't necessarily be buying stocks at good value, and buying stocks at good prices is really, really important. But if you then filter by 52-week lows, it's a good way of at least getting some discount from the peaks. But obviously the fact that it's down doesn't necessarily mean good things. It could mean that some sort of negative outcome has happened with the company. And it doesn't necessarily mean, so for instance, in the instance of Coca-Cola, their price has been sort of flatlining for a little while. And so the fact that it's at a 52-week low doesn't mean that it's that low from the top, but it's still a significant discount for a company that you just sort of know, like you don't never know, but you pretty much know that Coca-Cola is going to be there in 10 years. And looking at prices now, buying this one for this video, I had to pay £1.20 for it. And what's shocking is you just know that people are going to do it, because they have pricing power. That is the value of brands. They are fantastic things to buy and hold for significant periods of time. Okay, so let's just jump into the valuation. I'm going to share my screen. Hopefully that's popping up. Let me grab the Chrome tab. Might have some issues here. There we go. Beautiful. There it is. There's my screen. So these are the 5 companies that... so if you go to a site called 𝗏𝗏𝗏, that collects all the information on the world's best investors. It's a really good site to go to for just finding stocks to analyze. So you go to 𝗏𝗏𝗏, you consent to giving them all your data. And then down here is... when you scroll down... 5% or greater holdings near 52-week lows. So they're 5% or greater in the portfolios of the super investors, and they're currently at 52-week lows. And so, yeah, I think the ones that are interesting to me, the one I'm going to analyze in my video, General Motors, PayPal, Wendy's, Pepsi, and Coca-Cola. that's only because they are within my circle of competence for understanding how those businesses work. I understand what the product is and all of that. So I like having that sort of reassurance that I personally buy the product, and therefore I can understand Coca-Cola's. Oh, not interested in the stream data. I can understand Coca-Cola's moat, and that is really, really important. If, for instance, the share price was to drop 50% right after I bought it, I probably wouldn't be that concerned because it's fucking Coca-Cola. I understand how it works. And that is, to me, by the way, that's a little lesson. That's, for me, is one of the most important things in investing is basically you need to ask yourself, if you buy something and it drops 50%, what are you going to do? And if the answer is sell, and be honest with yourself, but if the answer is you'd sell if it went down 50%, then you're buying it for the wrong reasons. Okay, so got this spreadsheet. So 52-week low spreadsheet is what we'll call this. And kind of where I start is I look at the PE, then I look at the 5-year PE, and then I look at the, so yeah, this sheet is going to be dedicated to Coca-Cola, and then we're going to go through all the others. Cola, PE, 5-year PE. So to do the 5-year PE, we'll go, it's 2023 now, so 22, 21, 20, 19, 18. And so we'll get the earnings from there. So that is earnings, and yeah. So we want share price. What do we want? So we want earnings per share. And that should be all we need. And then we can divide it by the share price. And so we don't need to write that in all of these. So let's now go to my favorite investing website. I've got a tab of it here. And so Coca-Cola. This is my favorite website now. Finance charts. Found it on a value investing subreddit. The guy that made it posted it on there. Oh god, I've got to prove I'm a human being. There is the bunny. Please check all the large. Please click on the largest animal. Please click on the largest animal. There is none. Oh, but you got a photo of a bunny there. Oh god, these are getting so much more confusing. Anyway, submit. Right. So, where are we going to start? I'm curious. I one of the things I generally look at the beginning as well. I don't know why I do this because it's not particularly important, but I always look at the market cap. So that is 228 billion versus the revenue. And so then you just go to financials to get to revenue, and that is this is quarterly, so you got to scroll down for annual, and you got 40 billion, 39 billion. So like just that's one of the things that you'll notice about companies like Coca-Cola is even at a 52-week low, they're still expensive relative to their earnings, but obviously this is one of those instances in which you're paying for a great company. So you expect this to be expensive, but in ways I'll get into in this video, there are ways a company can be have a high multiple and be cheap. And it's usually to do with having a small ratio, a big ratio from your net assets to your earnings. So basically you make a lot of money from a small amount of stuff. It's the simplest way to put that. So, earnings per share basic. That is what we want. And so we got, so there's no trailing 12 months. So we're going to have to start at 2022, which is absolutely fine. Earnings per share basic. And you've got the earnings per share diluted. I mean, they're only 1 penny different. So it probably doesn't matter which we use, but let's just use the basic one for now. let's use diluted because then that's a little bit lower. 2.19. I know some people do some crazy charts and stuff for investing. I think it's just a bit of a waste of time because the level to which you can't predict the future and the level to which markets can be crazy irrational. So you're just eventually there's only a certain amount that you actually need to know about a business, and then beyond that you're just you can send yourself insane. You can't tell as much information as you think you can tell from these charts. 22, 21, 20, 19, 18, 17. Okay, and so 1, 2, 3, 4, 5. Oh, I've gone back a little extra year, but that's fine. Yeah, let's delete that. So what we want to do equals sum. We want to take these and just add them all together and divide them by 5. And that is their 5-year earning per share. Some people like to adjust it for inflation and stuff like that. That's a bit unnecessary in my opinion. And this just protects you in case that this year you had a particularly high or particularly low earnings per share. In this instance, you can see that we've got quite high earnings per share, and it's been offset by the 5 years ago. But if you adjust that for inflation, they're probably all about the same. Again, this is all about creating a margin of safety. So that is the 5-year average EPS. Let's just make that a little wider. And then what we can do, set one row above. And what is the price of a share? They are $53 per share, 53.3. $53.3 per share. And then, so we put that at the top. Share price 53.3. And so the price to earnings would be, so let's just see if I got this right, math-wise. Sum this divided by, got that the wrong way around, that divided by this. The earnings per share should be 24. So let's have a little look. Is it 24? 25.32. So have they used the diluted ones? Or sometimes maybe the share price thing hasn't updated. I don't think they update this every day. So it's a little bit cheaper than it was when it last did its calculations. The 5-year average earnings per share, and then you want 5-year average earnings per share, because I can't be bothered to type that all out, equals sum, basically that that divided by that. And so the 5-year average is a bit higher, which for me I don't like. So basically, if Crocs have, oh god, Crocs, I've been doing research on Crocs today, so that's why I said Crocs. If Coca-Cola have what would be considered a bad year, which they've not just had, 2022, still pretty good, like when you're looking back 2 years ago. If Coca-Cola have a bad year, maybe because they just risen their prices to £1.20 in the UK, it could send their share price sliding a little bit. And basically you'd be buying them right off an uptrend. And so, but I am going to do there's another thing I can do here. I could take a look at, so basically this is the other things that, to be honest, by the way, 24 and 27, these are unheard of valuations from like a year or so ago. But like during the pandemic, stock prices, especially for companies like Coca-Cola, were just absolutely ridiculous. And so kind of one of the reasons that this is not a discount, by the way, if you're holding for 10 years, you don't have to worry about this. You could just buy Coca-Cola. Already I can tell they're at a fair price. Basically, yeah, let's start looking at their compound annual growth rate. Annual growth rate. So 5-year total return, their compound annual growth rate over 5 years is only 40%. So compare that to Microsoft. They are not a growth stock anymore. That shouldn't be a surprise. Financials, ratios. The one that I like to look for is margin, how much margin they make. Might have to go to Yahoo Finance for that. If you got any questions, please just let me know and I'll answer them. I tried to answer them in this video. Coca-Cola. The Coca-Cola company. I also heard that Coca-Cola own shares in Pepsi and vice versa, which I think is interesting. Right. Whoa, operating margin 31%. Ooh, this is my first time looking at Coca-Cola's operating margin. I mean, it shouldn't be surprising, but that is like one of the highest I've ever seen. And operating margin is super important because if you have a high operating margin, basically you're earning lots of money relative to what you spend. And it basically just means that you can just go with the flows so easily. So what I'm talking about is basically you're making, if, for example, you need to double your production at some point, if you have a high operating margin, you can do that much more easily. And so that's one of the appeals of Crocs to me, is that they have a high operating margin. What was it? I did a YouTube video on this recently. Warren Buffett said it about COCA-COLA. The reason that they bought COCA-COLA for a price to earnings of 25, and like we're looking at Coca-Cola, they're a price to earning of 24. So right now, Coca-Cola are cheaper than what Warren Buffett paid for COCA-COLA. The difference being we'd be buying individual shares of Coca-Cola. Buffett bought the entire COCA-COLA company. And there is a difference when you go to purchase the entirety of something. You're generally willing to pay more because you're gaining more control and therefore you get more value out of the business. But anyway, bit of a tangent. He was saying that basically if you saw two businesses, both earned 1 billion. Theoretically, in your mind, you might go, oh, okay, they both earn 1 billion, so they're both valued at the same. If they both earned 1 billion a year, then you learn that 1 billion one company has 10 billion net tangible assets. So let's just write this down. Company 1 has, and company 2, and then 1 billion in earnings, and then 10 billion in earnings. 1 billion. And then, so earnings, so right now there's no difference. And then you go net assets. And this company has 1 billion in net tangible assets. And this company has 10 billion in net tangible assets. So on the face of this, you would think that you'd want company 2, right? But actually, you definitely want company 1. Company 1 is the much better company. Company 1 has an operating margin of 100%. It makes 1 billion by spending 1 billion. So its revenue would be 2 billion. Its assets would be 1 billion. And therefore, now in the second year of that company's operation, they could technically double their net tangible assets if they wanted to, or they could use it for share buybacks or whatever. Company 2 only makes 1 billion off spending 10 billion on net tangible assets. And so the company 2 is going to really struggle to grow the business, pay off debt and other things like that. And they haven't got a lot of buffer if they need to restock up to 10 billion. So company 1 is the much better company, even though they have less in assets. So earning power to your assets is way more important. This company is going to grow revenue, grow value for shareholders way faster than company 2 is, just on the basis of this limited amount of information. And so Coca-Cola has an extremely high capacity to earn money on on its assets, which should be no surprise to anyone, but I was a bit surprised to learn that it's 30% in this day and age, with all the inflation and everything. So profit margin 23.81%. That's profit margin across the entire business. Gotta love the taste of Coke. And is there any other things of value of interest in here? Oh, cash. That's an interesting one. 15.69 billion. That probably is not very much compared to it. So let's have a little look. See. Debt. Let's have a little look at that. So when we're above, I bet their debt's not going to be that much of an issue. Am I logged into Simply Wall Street on here? COCA-COLA. Look at that. Value, dividend, health, past. It's just a bit weak on the future, but everything else is pretty strong. And there it is. So it's a little bit, according to Simply Wall Street, it's a little bit below fair value at the minute. I just want to check out their debt. Look at that. That's nice. They actually make money. So they have quite a large amount of debt. So 43 billion in debt. Interesting. And if I go down to their financial health, and there's the cash, there's the 15 billion, and there's the debt, 43 billion. I mean, no one's worried about Coke paying off their debt. 43. You just sort of wonder what they really need it for. I'm a bit Dave Ramsey-esque. Like, they probably got that debt so damn cheap, but if you could just use cash, why wouldn't you? Sort of thing. I know that's not how these billionaires think. This makes it easier. So 16 billion in cash. What was their market cap? Because I got their share price, but I didn't get their market cap. Last close, 52-week range, market cap 228 billion. 228 billion. Okay. So if you knocked, yeah, cool. Right. So the compound annual growth rate, that wasn't that impressive. Let's look at all the metrics. Just looking at anything that stands out, good or bad. We could do a discounted cash flow, saying it's not got a margin of safety right now. And that lines up. Basically, it's at fair value. And that's the issue with, like, where we were a year or two ago. Nothing was at fair value. Except for Cineworld, which, yeah, let's not talk about that. Margin of safety. So the fair price range is 41 to 64, and it's currently sitting right in between that. So it'll be interesting when we go into... Oh, Pepsi-Cola apparently is definitely not undervalued. Well, that'd be interesting. We go to check it out. Monster Beverage. I've never done a valuation on that. That could be interesting. This is one of the things that bothers me is Coca-Cola's business is split up into all these other different things. But yeah, today we're just looking at KO. Okay, so I've more or less done everything I need to look at here. I can at least use this information that I have to compare it to other businesses. Let me just look at so overview, financials. I like to look at this chart, shares outstanding. And that's a beautiful curve down. But then they've just sort of hovered, started selling a bit of shares during the pandemic. Maybe they were just overpriced. It's quite wise. Okay. It's just obviously one of those really well-run businesses. Okay. Oh yeah, they got a dividend as well. So let's look at that dividend yield. Dividend yield is about 3.48%, which is lovely. You know, just like imagine putting 10k into this and just getting a 3.3% annual dividend on it. I mean, this is one of the things, like stocks and shares is so much more, such a better investment to bonds and other things. Because you get the growth of the business on top of, like for Coca-Cola, getting a 4% dividend yield. Oh god, actually, this is what could like make or break it for me. So dividend, right? You never want to be like rely on it, but if anyone could be relied on to give you a dividend, it's Coca-Cola. Look at that. So yeah, 3.5%. Let's just say you're probably going to get a dividend of 3%. They've basically always done it. See, that would be nice in it of itself. Screw crypto, 3% dividend from Coca-Cola, and then you can just basically the true value of this stock is the fact that it will beat inflation. That is the real big value of this stock. So I am actually now considering like, oh, could put some money into Coca-Cola. Right, let's go on to Pepsi-Cola and start comparing these two together. So let's delete all of this. Make that into bold. Delete that. Let's just put some bubbles around these as well. Make them look sexy. By the way, I love chatting to you guys. If you want to just throw some comments in the chat, got any questions? Oh, I just closed the 𝗥𝗲𝗊. I closed the 𝗥𝗥𝗊. By the way, you won't likely not be able to get access to this information on Simply Wall Street without a subscription, which I pay for. And so if you want me to do scroll throughs on Simply Wall Street, all you got to do is ask in the comment section. Okay, so let's do Pepsi-Cola. Just doing a brief scan, saying it's undervalued again. Been watching New Money's video today, which was really interesting. I can't remember the investor that he was following, but basically we are heading into, I think, generally about a decade of undervaluation or fair valuation for businesses. Just a sort of stagflation period. We're not going to see the same growth we saw before, so we shouldn't be projecting growth into these businesses. You shouldn't do that anyway. You shouldn't be projecting massive growth. What you should be doing is measuring a company's capacity to grow. And the capacity to grow is very different from whether a company will grow. And I know people like to measure the market size, but I think that's absolutely that's a bit of a fool's errand, because, for instance, there was no market size for Apple iPhone. The best thing you can do is, like I said, what you want is a company that makes big profits relative to the sorry, just weird noises. Hate being home alone. So yeah, what you want is a company that makes big profits relative to the smallest possible assets. So you want a company, just to describe it another way, you, like with the 1 billion in earnings for the 10 billion in assets versus 1 billion in assets, 1 billion earnings. A growth company will be company one in my example earlier. But basically, if you have $1 in assets, you want to make $2 from it. That would be epic. Like a company that has $1 in assets makes $2 from it. That would be the best company. That's a growth company, a company that can do that. And then there are things like entering new markets and stuff like that. But you just can't predict how a company's going to do when it enters a new market. The companies like Google and Microsoft, they enter new markets overnight. Netflix, like, maybe you could have done a bit of that analysis, but it's just very hard to predict. Okay, so right, let's just do what I did before. Start entering in this information. Check no comments. Just checking this is still alive. Yep. Righty. Pepsi. So the market cap is 218 billion, which is interesting. 218 billion. Now, a lot of people don't know that Pepsi do a hell of a lot more than just Pepsi. Actually, there's a couple other things that I didn't do in my last valuation that I usually do. Typically, I look at what the biggest earners are of the business, but with Coca-Cola, I don't feel I have to do that. But with Pepsi, I might have to. So, look at that. 5-year total return, it's grown 75%. But we can ignore that. And sorry, I'm really tired. So share price is what I want to know. 162. 162. And then earnings per share. Basic. So 5 that's trailing 12 months. I want this. So earnings per share basic 6.47. $5.51. 5.16. 5.16. And 5.26. 5.26. And 8.88. 8.88. And then price to earnings. Well, that will be equals that divided by that equals sum divided by 5 equals sum. Yeah, so that will be that divided by 5-year average earning per share. So the 5-year average still a little bit more, but not as much. That shows less variation in the earnings. Look at that. In 2018, actually, they were earning a hell of a lot more. £8.88. This is the sort of stuff that's exciting, because imagine adjusting that for inflation. So cash. How much cash has Pepsi got? Seems that the earning power of Pepsi is stronger than Coca-Cola. Cash. Free cash flow yield. What am I looking for? Balance sheet. God. Cash and cash equivalents. 6.11 billion. B. Debt. So let's go to Yahoo. Yahoo's better for debt. Pepsi beverage. Oh, God damn you. I'm no longer in Yahoo Finance. Pepco. Statistics. Let's have a look-see. Debt, 44.77. Let's round that to 45. 45 billion. Let's just write B. Oopsie. 21 billion. So then the dividend amount. What does Pepsi do for a dividend? The dividend amount is 3%. About 3%. They dip into 2.8 a bit more. Let's just put 2.9. Yeah, 2.9, just to underscore the fact that it's less. Oh, and it's rounded up. Okay, cool. So the PE is lower on here. The growth has been higher for Pepsi Cola. They probably adjust to inflation just about as well as Coca-Cola does. But I'm perhaps a little bit curious as to what makes up the majority of Pepsi Cola's earnings. So let's just go into their 10K. And that's what I like about this site. I've just clicked SEC filings, and I'm just going to their latest 10K. And then, I'm on their 8K, sorry. There's their 10K. And then if I just search segment, that only occurs 2 times. So we are organized into 7 reportable segments. Frito-Lay North America, which includes our branded convenient food business and the United States and Canada. Quaker Foods in North America. PepsiCo Beverages, Latin America, Europe, Africa, Asia, and all of that. And then have they broken their revenues down into each net revenue and operating profit. Okay, so the segments that they've broken it into is more to do with regions than it is to do with businesses. Drives me a bit nuts when they do that. I'd much rather they separate it into the different... So like when I hear revenue segment, I want to see Pepsi Cola separated from Quakers and stuff like that. So corporate. So our dividends are held accountable for share-based compensation expense, and therefore this expense is allocated to our divisions as an incremental employee compensation cost. The allocation of share-based compensation expense of each division is as followed. The allocation of share-based compensation expense for each division is as follows. So this is the share-based compensation stuff. Common stock, capital excess, retained earnings. And that's the analyst forecast. 1.25. Just looking at how much they actually pay in terms of dividend. 1.265. It's funny that they, so when you look at the fact that they're at a 52-week low, they're still not that low. It's nice to see them at a good price, though. I don't think there's much more analysis to do here. They're not at like a crazy discount. They're just good. Same as Coca-Cola. In this instance, I would just buy half of both of them because why the fuck not? They're both basically valued about the same. So you've got 8.29 billion there in earnings, 9.7, 7.6, 12 billion in 2018. What the fuck happened in 2018? I'm just gonna have a quick look at that. Why did they earn so much in 2018? Why you earn so much in 2018? Could that happen again? That'd be nice. 10Ks. Business, risk factors, unresolved staff, market restraints, selected finance data. Asia, Middle East, North America. Our segment net revenue in millions, contributions, consolidated net revenue for each of the last fiscal years were as follows. So when I go to older than 2018, what does it go like? So it goes 4 million in earnings, 63 billion in revenues, to same amount. How on earth were they making so much more? Cost of sales the same. Cost of sales actually went up. Revenue was the same. Revenue was the same. 34 billion gross profit, 35 billion gross profit. Expenses 29 billion. Expenses 24 billion. Net operating expense. Their expenses went down. So general and administrative, research and development, what went down? So 9.7. General administrative didn't change. Research development didn't change. Sales and marketing didn't change. They only spend 14 billion on that. That's quite low in my opinion. Net operating expense 5 billion. Net operating expense 2 billion. And then it goes up, and then it goes up, and then it goes up, and then it goes down. So occasionally their net operating expense drops a bunch for no apparent reason. It's not enough to really care about. It'd just be nice to know if we could get our earnings back to there, but I don't know if there's any way for us to know about that unless you're actually inside the company. It certainly wasn't massive revenue growth in that year or earning growth. It was just some reason their expenses dropped during that period of time. And it's since gone up, and they're spending a lot on sales and marketing, but yeah, that's fair enough. Okay, so let's just have another look at, go to Simply Wall Street, let's just compare that to Coca-Cola. I'm probably leaning towards Coca-Cola still. Dividend is healthier. Company health is healthier. I think Pepsi are just a little bit more unreliable. Anyway, what's that? So analyst choices, analyst checklist. I could do a discounted cash flow model for these. Where's this? There's stock MVP. Pepsi. Discounted cash flow, PepsiCo. Scroll down here. So EBITDA is 10, depreciation and amortization costs increase around 40% in the last year. So let's just put that at like 15. And then capex growth rate, capital expenditure growth, that's grown. Wow. So let's just move that to 20 at least. And yeah, let's put that at 20. Populate. Calculate. So long-term growth rate 4%, discount rate 12%, discounting the growth. It's saying it's overvalued. But you do pay extra for good businesses, but yeah, it's that capex rate. So now let's look at Coca-Cola. Oh yeah, I didn't populate PepsiCo's. Whoa! 44% return on equity. Okay. So I meant to delete, whoopsie daisy. Share price, price to earnings, 5-year average earnings per share, 5-year average cash, debt, dividend. Ah, did I not put that in here? Return on equity, but that's just trailing 12 months. So 40. And what was the other one? Return on assets, 8.59. So that's not very impressive. 8.59. On assets, it's just a bit of an anomaly there. If I go to quickfs.net, oh no, there is no.com, quickfs.net. Type slower. Pepsi. Go. Return on invested capital is on average around 20%, and it's been a bit lower in recent years. Coca-Cola, probably the same, right? KO. I'm gonna wake up. Okay, oh, whoa, that's quite volatile. And yeah, some dips in the return on invested capital. This is why projections are a little bit bullshit, because look at that. Look how bumpy the ride is. You can't predict these things. Anyone that says is just selling you snake oil. Return on invested capital. But yeah, that gross margin is nice. Operating margin 30%. Let's just have a little look at their key ratios. This is a worthwhile site to get an account with because it's free and it's epic, but I can't be bothered to log in right this second. Okay, I'm done looking at Pepsi-Cola. Duplicate. Let's delete this. Let's delete this. And let's just jump into GM because I want to look at them. And then this might be the last one. If you find this interesting, I'll do another live stream. Whoa! Oh yeah, this is car company, so they're always valued price to earnings of 4. Well, I mean, this one and VW are price to earnings of 4. The issues for car companies is growth. Really hard to make a lot of money off your net tangible assets. So Coca-Cola can spend 1 penny building this can of Coke and sell it to me for £1.20 at the shops, whereas General Motors, they'll spend 20 grand building a car and they'll sell it for 40 grand. So it's just a lot harder to make margin for car companies, and therefore they grow slower, and it's a lot worse for them when they lose money. And so generally they are accepting lower price to earnings. However, there's still a lot of opportunity here, and price to earnings of 4 is crazy to me. But obviously just remember the fact that they have to reinvest these earnings in order to keep the company afloat. And so it requires a lot of reinvestment. One of the reasons that Warren Buffett purchased, 𝗟𝗂𝘂𝘀𝘁cie recently, I believe it was 𝗟𝗂𝘂𝘀𝘁cie. He put a slide in his own presentation. He took a slide from 𝗟𝗂𝘂𝘀's financials and put it in his own presentation, and basically showing to the world that 𝗟𝗂𝘂𝘀 are no longer going to be building more oil rigs and going deeper and deeper and deeper. And basically, the issue has always been for people owning oil companies is that all these massive earnings that they get reinvested back into a newer, bigger oil rig that is more expensive and deeper in the ocean. Buffett has basically said, we ain't doing that anymore. This is the last round of oil rigs that are going to be finished. And then we're going to take those earnings and reinvest them into other things that we actually think are worth investing in. So in a way, Buffett is taking down the oil industry from inside. And this is kind of like what he's done with businesses like blue chip stamps. I made a YouTube video on that, Warren Buffett's top 5 stocks. And basically, sometimes he likes to buy companies. And when you buy the whole company, this is the thing. This is why it's different for people like Buffett. They can actually talk to the CEOs and convince them to do things like give money back to shareholders, which we just do not have that power to do. So we have to look at very different companies to Warren Buffett. So yeah, price to earnings of 4 sounds like such a good deal, but remember that is mostly going to go back into building new cars, and not likely into your pocket. But yes, of course, the industry that looks cheap. I know that VW has about the same price to earnings. I don't actually know what cars General Motors makes, so that would be something like, if, for instance, I was looking at this and I thought it was cheap, I would be looking into the cars they make next, and all sorts of other layers to the business. So 10 billion in earnings, how consistent is that? Yeah, generally business that operates with profit, which is great to see. Let's look at their debt to equity, no less scary than Coca-Cola or Pepsi. Let's see, debt level, net debt to equity ratio is 122, is considered high. All these companies have massively high debt to equity ratios. 122 is not that bad. Reducing debt coverage. GM's debt is not well covered by operating cash flow. Interesting. But they look fine. They're relatively healthy. But that debt is going to get more expensive. So dividend, wildly inconsistent, 5%, 5%, 5%, then cancel. And then that looks like that has a massive, has a bit of a hit to the business. And yeah, so back to doing, and now they do a 1% dividend, and then they, oh yeah, analysts forecast, they're not forecasting dividend, but they are forecasting that it's going to go up. Woo. without knowing what General Motors cars are, so I've got shares in VW, and I happen to know, I'm familiar with their electric cars, and I think they're interesting, and so that adds a level to why I'm invested shares in them. But it is interesting that super investors are holding onto this stock. So let's just put their financials into my sheet. So let's just go General Motors, and then we can close those SEC filings. General Motors statistics. Yeah, so look at that. That's what I'm talking about. That's what you expect. They make not very much relative to their assets. Operating margin 6.42%, profit margin 6.05%. I'm just going to write 6% for both of those. Return on assets 6%, return on equity 6%. So when they go to reinvest their profits, it's going to take them longer to grow. And there's just so much competition in the car industry. It really is a miracle what Elon Musk has done. It genuinely is groundbreaking. Tesla gets, I was about to say that he doesn't get enough credit. He absolutely does get enough credit. I think a lot of the criticism is just ill-informed, but you know, when you're that rich, people are going to criticize you. Just going to get over it. Total cash, 27 billion. Total cash, 27 billion. 27B. Ooh. 27 billion debt. Okay, I put those profit margin things in a bit of a funny place. I see that now. Debt. 120 billion. So again, if I was going to do a deep valuation, if I was like actually going to buy this, I'd be looking at when that debt is due and what the percentage on it is, like how expensive is that debt. We could look at short-term debt because that debt is so high. So let's just see. They will also have a lot in receivables, I reckon, because of financing the cars. $30 per share, $30.86. And where's the market cap? Market cap, 41 billion. 41B and $30.06. So price to earnings, let's 5-year average, so I can just work out all of that myself. Dividend 1% at best. Laptop is just low on charge. 𝗟𝗂𝗀𝗃𝗃. So 1.81. Right. 1.81. Whoopsie daisy. Good. I am too tired. This is going to be the last one I do because I'm just going to give myself more work for tomorrow. So earnings per share, let's go for the lower one, diluted 6.13. 6.13. 6.7. 4.33. 4.33. 4.57. 4.57. 5.53. 5.53. So this is how pervasive dilution is, because it looks like there was a bit of dilution going on here, subtle. But it can really have a powerful impact on the actual value of the business. So it was there. It's there where they did some dilution. Diluted shares outstanding. They had 1.57 billion. And now they've got 1.54. So they've been doing... They did some buybacks and then they sold a bunch. Let's just actually look at this. 5 years. So we have more shares in system now than we did before. Let's look at Apple. Just see the advantage of share buybacks. Income statement. You got diluted earnings per share. I see. Now it's hurt my head because diluted earnings per share should be higher. Have I got this wrong in my head? Basically, I knew Apple do tons of share buybacks. Really what it should do is basically show what the earnings per share would have been had you had the current amount of shares in circulation. But I know they don't do that. Anyway, not interesting. So we got the earnings, a 5-year earnings per share. And so we can do equal sum 5-year average that, and their price to earnings equals that divided by that, and we got equals actually that, basically that divided by that, and then that one we actually want to do that divided by that. Done that wrong. That divided by that. So you see the price to earnings looks lower than it theoretically is because basically once you take all the earnings from several years, you realize that actually basically the earnings aren't as strong. I don't know, there's not much difference. It's not a tiny amount of variance. There's not a massive amount of variance here. Occasionally what you find is companies with really high PEs, and then once you do the 5-year PE, you get a lower result, and that suggests serious undervaluation. Basically, we just had a massive amount of capital expenditure or a massive amount of, or just a massive earnings dip just for that particular year, and the previous other years have all been really, really good. So that's the best thing to use that on is generally index funds, but it works for stocks as well. It's just good to not rely on the PE. The 5-year PE is better, and I wish it was just a standard thing to do the 5-year earnings per share to price, which is technically called the 𝗟𝗂 PE, but that just lots of sites don't publish the 𝗟𝗂 PE, and they should. Anyway, so that's it. That's my valuation so far. I know I haven't assigned prices to any of these, but price is so subjective. What do you pay for the fact that a business will reliably give you 3% a year versus a business that might give you 5% a year? It's there's so much subjectivity in investing. It's why I think it's better to keep things simple and look at things that you know about, and things that you like. I think that's really important. God, sorry, there's my face a little bit more in the shot. Really important to get things that you know about and you like, because there's so much subjectivity. The share price could drop 50% at any time, and you've got to understand what you're holding when it does that. And that's everything I'm talking about. If you want to see the more detailed version of this video, I'm obviously going to do more analysis on all of these businesses behind the scenes. Generally takes me 16 hours roughly to do the research for these videos, and then it takes me another 24 hours to edit them. 8 hours to film them. So yeah, that's all from me, guys. Please leave me any questions if you want to know any more about these